Oppure questo sì, è vero? Sì, sì,
Lecture 5. Quante pagine?
Quanti?
73.
Mamma mia,
Mannaggia. Mannaggia.
che ben imparato.
Hi again. Good afternoon. So before we start, just a little bit of planning. I have to finish a little bit earlier today because I have a meeting back in Illinois. So I suggest maybe we just try to go straight today because I probably have to finish like half an hour earlier. So because of my meeting, so we just go straight and if we finish this lecture, we finish, and then otherwise we'll stop at like before 4 p.m. Okay?
Okay.
So we're not gonna have a break. Is that okay?
Yes.
Okay. All right.
No.
Thank you.
那其实不就上次说了2个 mini case？
对。
All right.
还
So
没有直接上两次。
this lecture is about the other major type of financial decision that a corporate manager needs to think about. So, which the big topics of this class we're talking about is how managers make financing decisions, right? So we talked about financing investments with debt and equity, and with several examples of different types of investments, right? And then we talked about payout, right? The third major leg of financing decisions that managers, that corporate managers have to know about, the financial manager, right? I mean, not everybody in a corporation, but people who deal with finances of a corporation needs to think about is this notion of risk management, okay? That we're going to talk about in this news. So what do I mean by risk management? The idea here is to use financial markets, financial instruments, not to raise cash necessarily, but to manage risk. Okay, so the idea of risk management is that companies can use contracts such as futures contracts, forward contracts, options, in order to reduce and reallocate risk, right? Pass the risk on to other traders and choose which risks to take. So this is the idea of risk management or hedging, right? So those are kind of almost synonyms. So what we're going to talk about is how companies can use these traded contracts to reallocate risks and to choose which risks to take, and then also talk about some substitute mechanisms. So it's not only about derivatives. Companies can also use other standard mechanisms such as liquidity, supply contracts, and what we call operational hedging. Okay, so my goal is to give you an introduction to most of these ways of reducing risk, and then after that, no, not today because we're not going to have time, but on Monday we'll do a few cases about the risk management and liquidity management. Okay, so this is the plan. And as I said, this reduction or reallocation of risk that we're talking about here is what we call hedging. Okay? So like I said, these are synonyms. It might be good for you to know that when you hear the word hedging, that's what we're talking about. Okay? And what we're going to do is first we're going to talk about hedging in general. So what are good, valid, sound motivations for hedging? And in particular, we're going to focus on the distinction between hedging and speculation. Okay, so it's important for a financial manager to understand that when you deal with derivatives, futures, etc., it's very easy to be tempted, to use derivatives in the wrong way. And rather than use derivatives to hedge, managers sometimes end up speculating. And there is, it's after, if you consider this carefully, it's fairly straightforward to figure out, to separate hedging from speculation. But at first it's not, as you can see, sometimes it's not easy to make the right call. Okay, so this is something we're going to focus on. So that's what I mean by right doing and wrong doing. It's easy to go in the wrong direction. Okay, so that's really the topic of the first notes, is to give you some initial thoughts on how to distinguish hedging from speculation. But this really comes with more examples, and I think especially after the case studies that we're going to talk about on Monday, I think they're going to become more clear to you. How can we really distinguish between hedging and speculation? How can we assure that as a corporate manager, I'm using the risk instruments in the right way? Okay, so this is a very important topic in corporate finance as well. So let us start here with some examples of situations in which managers may consider using hedging instruments. Okay, so the first one is reducing volatility, right? So here is suppose this is like a manager talking. Okay, so the CFO in this case is concerned that the company is in a cyclical business and therefore profits are very volatile, right? So there's a lot of fluctuation in profits, and therefore the manager's idea is to use derivatives to try to smooth fluctuations in profits. Okay, and this seems reasonable, right, when you first look at it. I mean, what's wrong with that, right? What's wrong with reducing risk? Okay, this should be reasonable, but in fact, there's something wrong with this argument, right? Of course, it's in the slides as always. So, what do you think? Why is this not right? Any ideas? What could be wrong with this, reducing risk? Remember, what's the goal of a company, right? The goal of a company, as the financial goal of a company, is to maximize shareholder value, right? So the problem with this argument is that reducing risk per se is not necessarily going to increase shareholder value, right? Because shareholders, if you're talking about diversified idiosyncratic risk, right? Shareholders can do it on their own. This is one of the central ideas behind the capital asset pricing model, right? That shareholders only care about systematic risk, right? It's the risk that you cannot diversify, right? So shareholders can do it on their own, and if you think about it more broadly, really, reducing risks, right, cannot really be the goal of a company, right? One of the central tenets of finance is that to create returns, you have to take risk. Okay, so reducing risk is not really the best way to think about hedging. Okay, there are some situations in which reducing risk might make sense. We're actually going to talk about financial distress in a second, but in general, you have to be careful with this argument. Okay, hedging is not really about reducing volatility or reducing risk. There are better arguments. Does that make sense? Here's another problematic argument. So now you have a company that uses steel as an input. Okay, so this company is buying steel, and the CFO believes that the CFO has learned a lot about steel markets, right? So now he and she can predict what's going to happen to steel prices, he or she, right? So the CFO can now figure out, and so now the CFO decided that the company is going to short steel, right? We're going to talk about shorting. Essentially means selling, right? So you're going to take a short position on steel. So if the price of steel goes up, you lose. Okay, we're going to give more examples later of what shorting means, etc. But right, so this company is going to the futures exchange to short steel because the CFO believes that steel prices are going to go down, right? So if prices go down and you have a short position, you're going to make a trading profit. What's wrong with this? Again, it seems reasonable, right? As I told you in the beginning, it can be tricky, at first, to really narrow down and focus on the right, the rational, right? But this is an example of what we call speculation. Okay? The goal of hedging is not to allow the CFO to allow a company to profit from futures markets. Okay? That's not what a company does. That company is using steel as an input, okay? And and then you're producing something. Your goal is to make a good product, right? You're not your goal as a CFO is not to is not to try to profit from a futures market, right? And who knows? Maybe the CFO. What we also learn in finance is that it should be very difficult to predict prices, right? So maybe the CFO is overconfident and doesn't really know what he or she is doing. Okay, and this is a classic example of what we call speculation. Okay, my view is there is nothing wrong with speculation, but speculation should be done in a bank, in the trading sector of the economy. So if you go to an investment bank and you start trading, fine. Okay, so but if you're managing the resources of a company, okay, then you should not you should not be speculating with the derivatives. This is why, I don't know if you heard, there is a famous investor in the US called Warren Buffett that you might have heard of, and he likes to say that derivatives are a weapon of mass destruction because it's very easy to misuse. Okay? And this is one of the examples, right? The CFO might just think that it's easy to generate profits instead of just trying to reduce costs and improve operations and help my company in that way. Then we're going to just go to the futures exchange to make money. Okay, but this is a very dangerous proposition. And as we're going to learn later, we haven't gone there yet. This position is also in the wrong direction. Okay, but we're going to talk about that later. That's another way we can distinguish hedging from speculation. In a case like this, if the company wants, as we're going to learn later, but just to anticipate a bit, if the company wants to hedge the fluctuations in oil prices, in this case the company has to buy steel. It has to be long on steel, not short. Okay, but we'll talk about that later in more detail. Okay, so those are the bad reasons. So remember, we want to kind of rule out speculation, and we want to rule out simplistic stories about reducing volatility. Okay? But what are then the good reasons to hedge? So I think there is at least 3 different but related motivations that we can talk about. Especially the first 2 bullet points are very related. Okay? What you can do with financial markets is choosing which risks to take. It's not about reducing total risk, but it's about using financial markets to eliminate risks that you don't want to be exposed to. And you can't eliminate everything, right? Like I said, when the central principles of finance is that if you eliminate all risk, then you have no return. You're not, it's impossible to create value. But what you can do with financial markets is choose which risks to take, which is kind of related to the second bullet point. This idea of eliminating risks that are outside of the company's control. Okay? So here's an example. We have a US company that opens a new branch in India. Okay, so you're a multinational company that now you're going to start selling products in India. Okay, because you have a good product. Okay, you want to be exposed to the Indian market because there is a lot of demand, and you think Indian people are going to love your product, and you're going to make money that way. Okay, what's the problem? The problem is you can't sell in dollars in India, right? So when you move sales to India, you're going to create exposure to the Indian currency, right? It's the rupee. Okay. So now the question is, does the company want to be exposed to exchange rate risk? Right? It's not necessary. If you think about it, you can't really expand to India without being exposed to the Indian market, right? So that you can't hedge the risk that Indian people are not going to like your product, okay? But the fluctuations in the currency are totally exogenous to the company. It depends on what the Indian government is doing, what's happening in international financial markets, the interest rate in the US. Those are things that have nothing to do, right, with the company's product, with how Indian people think about the product. Okay? So what the company can do in this case is it can go to derivatives markets to eliminate. And as we're gonna learn, it's not easy to completely eliminate risks, right? But at least the Indian company can reduce the exposure to the Indian currency by hedging currency risk. Okay, so you can think of this example. The company going to India exposes the company to two risks, right? There is a demand risk that people are not going to like your product as much as you want, and then there is the currency risk, right? So the first one, that's your business. It really does. I mean, you would like to eliminate that risk, but you can't. That's the bet you're making, right? As a company, you have to make bets. But there is no reason why you should be exposed to the Indian currency. Okay? So you can choose to eliminate that. So you are sure that your business is going to fail or succeed only because of what Indian people think about your product. It has nothing to do with fluctuations in the Indian currency. Okay, and we're going to give more examples. Actually, hedging currency risk is a very good way to give examples of hedging because we can get data and it's fairly straightforward. It's not the only risk that makes sense. We're going to talk about other examples too, but many of our examples are going to be about currency risk. Okay, so one thing we're going to learn is in this case, right? If a U.S. company wants to eliminate Indian currency risk, what is the position you need to take? Okay, we're going to talk about that later. Any questions so far? So here's another example. As I said, the first two motivations are very related, right? So the U.S. multinational is choosing not to take currency risk. That's a very common, valid motivation to have. Okay? Here's a related, motivation. It's an example of an airline, right? And it's actually a very practical example as well. Many airlines decide to hedge the risk of fluctuations in oil prices. Okay, so oil price is a major input, right, for any transportation business. Okay, and if you think about it, it's a choice of the airline, right? You can choose whether you want to be exposed to the risk of fluctuation in oil prices, or not, right? And this is a risk that is relatively exogenous to what the company is doing. The airline has to, like have good routes and good service and try to have nice airplanes, right? So people want to buy tickets. But the fluctuation in oil price is going to affect the profits of the company, okay? So in some cases, the airline might want to eliminate that risk, the oil price, right? So for example, if you want to improve executive compensation, right? So the compensation of the CEO is of course going to depend on how the company is doing. So the company may not want to pay the CEO more if oil prices go down, right? Because that increases profits, but the CEO has nothing to do with it. By the same token, the company doesn't want to punish the managers because oil price is increased, because that's a risk that is outside of the CEO's control. So eliminating risks that are exogenous, that are outside of the company's control, can improve compensation packages, right? So it can make it more precise and really make sure that compensation depends on how the company is doing, right? And whether the CEO of the airline can create good products and etc., and not depending on oil prices. Okay? So that's another example. And then there is, this is as I said in the beginning, in some cases, it does make sense to reduce volatility. And that has to do with our discussion of financial distress that you had with Professor Salvi, and we talked about yesterday as well, right? We learned that financial distress reduces value. And eliminating cash flow risk can help in that case, right? So for example, now we suppose we have an airline, and the airline claims that the reason why the airline is hedging oil prices is because not because of executive compensation, but it's just because the airline is highly levered. Okay, so then the problem is, if you're highly levered, a shock to cash flows can cause you to become financially distressed, right? And financial distress reduces value, as you learn, right? So we can think about in a simple graph. Think about this in a simple graph, right? The airline profit depends on oil price, right? So you have, let's say we have two states, just to be simple, right? You have two states of the world here. If oil prices are high, your profits decrease. If oil prices are low, right, your oil prices increase. Okay? So, right, if the airline has no debt, then maybe you don't care about the state of the world in which the oil prices are high, right? I mean, you have low profits, but that might not lead to financial distress. I mean, you might be hedging for other reasons, right? So volatility of profits decrease, as we said, but shareholders may not care about it. Maybe the company, as we said, the company may want to eliminate oil price risk for other reasons, but the volatility of profits doesn't necessarily matter. But then, if we compare it, in this case, with an airline that is highly levered, right? So now the problem is, if oil prices are high, right, that's going to reduce your profits, and it might affect your ability to service your debt. Okay? So in that case, it might make sense to reduce volatility. Or it's true, even if financial markets tend not to have this type of products, but that are directly related to companies' business. But if there was a product that allowed the airline to hedge the risk of not selling tickets, then that might be desirable as well in this case because of financial risk, right? Okay, so the problem now is the airline may not be able to repay debt. If you don't repay debt, then you have bankruptcy costs, as we talked about, and that reduces value. So reducing volatility in that case might make sense. Okay? So it is a good reason, right? Avoiding bankruptcy is another good reason to hedge. So in a way, what this is saying is that risk management decisions also interact with the leverage and the capital structure decisions. Any question on this general discussion? Okay. So now, what we can do is we can talk about specific ways in which companies can hedge, and then I'm also going to show you how not only which products can you use, but also which direction, how to take a hedging position in the correct way. Okay. So the first example, the most obvious example, is to talk about the traded contracts. Okay, so futures, especially futures, forwards are financial contracts that sometimes are, in most cases, are not traded, they are bilateral contracts. We'll talk about that too. But this is a good starting point. Okay, because it's a good example of how we started, right? How companies can use financial markets to reallocate risk. So, right, so futures and forwards, the issue is that futures and forwards are not available for every type of risk, right? So you can think of these, the risks that typically can be hedged using futures and forwards are what we call traded risks, right? So currency for sure, that's a great example. Commodities, right, like oil, steel, okay? And then there is also interest rate risk that we're not going to talk much about, but you have contracts that companies can use to hedge interest rate risk, especially the risk that government interest rate is changed, more than the specific company-specific spreads. But those are the most prominent example of a contract. And of course, financial markets are always developing, right? So there are new financial contracts introduced all the time. For example, now we have weather derivatives as well. So companies that are exposed to whose cash flows are exposed to weather shocks can use weather derivatives to hedge that risk. This is like this. For 10, 15 years ago, those contracts were created. Okay, so let's start with a forward contract. Okay, so let's understand what a forward contract is, and then how companies can use it. So a forward contract is essentially a piece of paper. Okay, you can think of it as a piece. It's a promise. Okay, it's a contract that you write with a counterparty. Okay, that specifies a particular transaction in the future. So we're going to give examples of currency. So for example, you might specify with a counterparty that in the future, in a few months or in a year, you're going to provide the counterparty with $100 million, and the counterparty will give you, let's do the other way, because it's easier to do the math. So you're going to provide your counterparty with 100 million euros, and your counterparty will give you like $130 million, for example. So this is written in a piece of paper, okay? And when the time comes, the counterparties have to honor the contract. Okay? That's basically what a forward is. When the maturity date comes, the two counterparties settle, the standard language for honoring the contract is settling. So they're settling, right? So you make the specific trade when the maturity date comes. And typically, the way that forward contracts are written, there is no cash exchange when at the initial date, when the contract is written. There's no exchange, like the counterparties don't really pay anything. So it literally is a promise. It's just a piece of paper saying that when in a certain time, when the future comes, you're going to execute that trade. Okay? So here are some examples of forwards. This is on currencies. I think it's really the only, it's relatively older the data, but it serves well as an example. So in the currency market, some parties, you have to be a fairly high credit risk company to do this, but some companies can actually hedge risk using forward contracts with banks. Typically, the counterparty is a bank, or banks can hedge risks between themselves. Okay, so here is this was the data from December 30th, 2014. So you have different currencies here, and you have on these columns, right? You have the closing date. So the first column is essentially the current exchange rate. So the euro dollar, for example, the euro dollar at that time was 1.2165. If you can read here, I hope you can read. Okay, and then what the table gives you are the forward rates that prevail in the market for future dates. So, for example, using the euro, 1 year from now, you could buy or sell a forward contract in euro dollar at an exchange rate of 1.2230. Okay, so that means you can write a contract with a counterparty saying, for example, that in 1 year I will provide you with $122.3 million and you will give me 100 million euros. Okay? When you look at currency exchange rates, sometimes it's tricky to know. Of course, one currency is in the numerator, right, and the other is in the denominator. And with the euro dollar, we kind of know, right, that the euro is stronger than the dollar. Okay, but in some cases you might not know. Typically, the way that currencies are reported is the weaker currencies in the numerator. So, for example, for Russia, okay, see the ruble is in the numerator. So this is rubles per dollar, but the euro is dollars per euro. It's just convention, right? Because people don't like decimals sometimes. I mean fractions, right? So instead of doing 0.00 something, you report the currency as 55 rubles per dollar. I also find it more convenient that way. But then sometimes you don't know exactly. Like here with the Swiss franc, I honestly don't know if this is dollars per franc or francs per dollar at that time. We'd have to go back to figure out. 0.98. I mean, who knows, right? So it's a good idea every time you deal with currencies, when you write these numbers, let's say in the exam or something, right? Always make sure you know which currency is in the numerator, which one is in the denominator, because it can get you astray, right? And this is trivial stuff, but if you're not careful, you make a mistake. I might end up making a mistake today in class talking. You'll see. It's very easy to get currencies wrong. Okay? So that's an example, right? So how would a company use these currency forwards to hedge? So, but we have to go back in time to the time that I got that table from the Financial Times. Right, so as you can see here, this is data for December 30th, 2014. So suppose, we are in December 2014, right? And the case here is a US company that has to make a future payment in rubles. Okay, so you have a contract, doesn't matter what it is, the product, this is pure finance, okay? So we don't have to think about what the product is, but you have to make a payment to a Russian supplier. A Russian supplier is providing you with some, something, right, some widget, and you have to make a payment, but the payment is not made today. Okay? You only have to make the payment in 1 year. So that's good, you have time. You're essentially borrowing money from your supplier, right? You don't have to spend cash now. But there's a risk, right? What is the risk that the US company faces? The currency changing, right? And let's practice this. It's, we have to, in general, it's good to know which direction is bad for the company. That's helpful. It's not always necessary, but in many cases it's helpful, right? So which direction would the US company be worried about here? You have to make a payment in rubles, right? So if the dollar appreciates, is that bad? No, right? You're worried that, everybody see that? You're worried that the ruble is going to gain in value relative to the dollar. So when the time comes, your payment is going to be higher in dollars, right? Which is what you care about. Okay? So let's see if I did it right. Yes. It's very easy to get this wrong. Okay? So you have to be careful. Right? So the US company is concerned that the ruble might appreciate against the dollar, right? So that when the time comes, if the value of the payment goes up. Maybe that's not a disaster, you can make the payment. But as we discussed it before, why would you be subject to that risk? It's a choice, you can choose not to, right? So how would the US company be able to eliminate this risk using forwards? What can the company do? Right? You're going to have to enter a forward contract. This is on currencies, right? And the forward contract specifies an exchange rate, right? So what the forward contract is going to allow you to do is to fix the exchange rate at which you're going to execute the transaction, right? So what the company does in this case, it's to buy a forward contract for rubles, right? Think about this. What you need 200 million rubles in a year, right? One option is to wait until you get there and then you go in the stock market and buy the rubles. The other option is sort of buying the rubles today, but without necessarily spending cash, right? And the way you do it is by entering the forward contract. So if you go back to that table, at that time, the 1 year forward rate was 64.885 rubles. Okay? So that means you can write a contract with a counterparty, right? At which the counterparty can provide you with 200 million rubles, and in exchange, the US company provides the counterparty, we can do the math here, right? Dividing 200 million rubles by the exchange rate, and that's why it's important to know, right, that the exchange rate is rubles per dollar. Okay? Otherwise, you would be doing the division in the wrong way. So that's where the math can get wrong sometimes, you see? But in this case, it's pretty clear, right, that the ruble is, and you can search online if you are in doubt about, which currency is stronger or weaker, but in this case, the ruble is the weaker currency. So the US company makes a promise to pay $3.082 million, and your counterparty makes your counter promise to provide you with 200 million rubles. So what the US company achieved is, now you're assured, right? Think about this. Now the US company is assured that the Russian supply that you're buying is going to cost you $3.082 million, irrespective of what happens to interest rates, exchange rates. Okay? So that's, a numerical example of that. Everybody understood that? Does it make sense? Right? So that's the explanation there in words. Right? So you lock it in a payment, right? And you can't lock in the payment at any rate, right? It has to be at the prevailing forward rate or the prevailing futures rate, which really is the more common rate. We're going to talk about it in a second. Okay? Right? And now it doesn't matter what happens to the exchange rate anymore. You're not going to pay more than 300, and you also know you're not going to pay less, that we're going to talk about that in a second, there is a downside to this, which is that if the dollar appreciates relative to the ruble, then you're going to be paying more than you would if you had waited, right? I mean, in finance, risk means return. Eliminating risk eliminates gains too sometimes. So the company has to choose whether you want to be exposed to that risk or not. Okay? But here is a problem with the forward contract, right? I mean, if you're thinking about it, how can this piece of paper, right? I mean, I'm from Brazil. Many people here from Italy, we're not very good at contracts, right? In Brazil, at least. I don't want to, dump on you guys, but Brazilians are, a Brazilian company would probably not be able to enter a forward contract like that. It's just a piece of paper, right? The bank is going to demand some collateral. Okay? So that's not a forward contract. I guess what we're going to talk about later, how if companies can use future risk to do that, futures exchange to do that. But of course, what we're talking about here is settlement risk, right? So what you're worried about is when all you have is a piece of paper. You can try to execute in court, but if this is a Brazilian company, Brazilian courts are horrible. And it's gonna take a long time for you to get anything back. So it's unlikely. That's the real reason why, because the courts are so bad, right? It's unlikely you're gonna get your money if the Brazilian firm defaults on your contract. Okay, so there is settlement risk. Okay, so the forward contract only works if both parties are reliable, or if the contract can be easily enforced in a legal court. Okay, and this is why futures contracts were created. Okay, so futures contracts is going to allow you to perform the same economic transaction in a way that has a lot less settlement risk. Okay, it's not going to be free. It's not a free for all. Okay, there's going to be a cost involved here, but it's going to allow traders to eliminate the currency risk without without creating significant settlement risk. Okay, so how do we solve the settlement risk problem? Instead of having a piece of paper that a bank writes, instead of having this specific contract, we're going to have a standardized contract that companies and anybody, right? Anyone can trade futures. So you can go to the futures exchange and buy or sell one of these contracts. Okay? So they are traded just like a stock. The futures is traded and is traded in a derivatives exchange. Okay? And just the fact that the contract is traded doesn't really guarantee that it doesn't have settlement risk. Okay? But the exchange will also require buyers and sellers to have a margin account. Okay, so we'll see how the margin account works, but it means that it's not going to be zero cash. To enter one of these future contracts, the company has to set some cash aside as collateral for the contract, and you have to deposit this cash in the margin account. Okay, so we'll see how this works. But let me give you some data on futures. This is for, now it's a pound dollar futures. And this table is nice because it's telling you, if you look up there, it's telling you that this is dollar per pounds. Okay? We kind of know that the pound is worth more than the dollar. I think you would know. But in case we don't, this table actually tells you, right? And it also tells you that now we have standardized contracts. Okay, so you can't just write a contract for any value. Okay, so this contract is standardized, and the value of each contract is written there. It's 62 pounds 500. So that's the minimum amount you can buy. Okay, So that's the value of one contract, and if you want to buy more than one, you probably can, but that's the minimum one. It's the value. It's like a stock price, if you want, but not really a stock price, right? It's sort of the minimum transaction, almost like a tick. It's what you can buy or sell. The price is the futures price, right? So here you have the data, right? Settle. The green column is the settlement date. Okay, for essentially gives you the futures rates for those different time periods. Okay, so you can, for example, you can buy or sell pounds at a rate of 1.2373 for delivery in September 2017. Okay, so this I think this is October. No, the date is not here. I should have put the date here. I believe this is October 2016. Okay, so you can buy. So the forward rate, right? Here also have open, high, and low because this gives you the intraday movements, right? So there is an opening value, there is etc. But we can focus on the settlement. Okay. So very similar. Okay. This is very similar to the forward, except that now the contracts have moved to an exchange. Okay. So yeah, the table is in October 2016. Yes, now I remember. Okay. So suppose it is October 2016, right? And now we have a U.S. company. It's the opposite situation now. So the U.S. company now is the supplier, and you have a contract to deliver something, that doesn't matter, right? As we said, a widget to a UK company, right? In exchange for 1 million pounds. Okay, so you expect to receive a payment. You're selling something in pounds, and the payment is going to come in September 2017. So it's only 1 year from now. You're giving you're giving your trading partner, right, the time to pay. Okay. So again, how can the U.S. company eliminate? So the same problem as before, right? There is no reason why the U.S. company needs to be exposed to the exchange rate risk. Yeah, maybe you want to, maybe you don't. Okay, and you can use futures markets to eliminate, or in this case you can actually eliminate. We'll talk more about that later, but at least reduce the your currency risk, right? So what can the U.S. company do? In this case, right, what you would do is, now you have to sell futures on pound, right? Because you're going to receive a payment, right? Now it's the opposite transaction, so you're receiving a payment in pounds, right? So, in order to lock in your exchange rate, now what you need to do is you need to short the futures in pounds. Okay? So what does this mean? It means that when the time comes, right, the U.S. company is going to assure, as we're going to see in a second, the U.S. company is going to assure that you have a fixed payment in dollars. It's exactly the same way that happened with the forward contract, except that now this is done with futures. Okay? So now we also have to think about how you execute the trade, right? Each future, like we said, corresponds to 62,500 pounds, right? So you need to short. In this case, you need to short 16 contracts. Okay, so the math is there, right? Because you need a payment of you're receiving a payment of $1 million, right? So this is in thousands. Okay, so this is $1 million divided by 62,500. 1 million pounds, right? Divided by 62,500 pounds. Okay. And then to enter this position, see how you change exchange rate, right? So to enter this position, let's say you're doing this. This data comes from the Chicago Mercantile Exchange. You know, it could be another futures exchange too, but let's say this is the CME. So what will happen is the CME is going to require a cash deposit, as we talked about. So to enter this position now, right? You're going to have a contract, a written contract that says that when the time comes, right, you're going to commit to deliver pounds, right, and buy dollars, but it's not zero cost anymore. Now you have to deposit cash with the exchange. Okay? Right, so and the other technical detail about futures markets that is important to know is that the position is what's called market to market. Okay? So let's see how this works. So the current futures price for that, if you go back to the table, right? The current futures price is 1.2373. Okay? That's the futures price for a contract to be settled in September 2017. Okay? So that's where I'm getting that number. So now, futures that's just like a stock. Okay? These prices change depending on what's happened to currency markets. Okay? So it's possible that, and remember, we were in October, right? The US company entered this position in October, right? So now let's say that in November 2016, the futures price increased, right? So now it changed. It increases, depends on which currency you're thinking about. But in this case, it increased, right, to $1.3 per pound, right? So what happened here? The pound appreciated relative to the dollar, right? Okay, because now 1 pound is worth $1.3, so the pound appreciated relative to the dollar. Okay, so let's think about how this changes the position, right? And remember, our company, we assume that you hedged the risk, right? So you enter this position with the futures exchange. Okay? So the first thing to notice is that the US company lost money on the futures position, right? Because the pound appreciated relative to the dollar, and you were short pounds. Right? Your contract, it was a contract in which you're selling pounds and buying dollars in order to hedge you're going to receive a payment in pounds in the future, so you have to hedge that risk by selling pounds and buying dollars. So the US company lost money in the futures position. Okay? So you have, if we do the calculation here, changing it to the $2, right? So you have, this was the size of your position in pounds, okay? Multiplying by the exchange rate, we get a loss of $62,700. Okay, so it's just like stock trading, right? I mean, you have a stock position and you lost money on your position. Okay? What will happen, technically, the way that the CME is going to the CME is not going to wait until the end, for you to settle this position. What the CME will do is, it will deduct this amount from the margin account. Okay, so remember, you had a margin account with $100,000. Your position lost $62,700. So what the CME is going to do is to take that cash from the margin account and mark the position to market. So you kind of realize the loss at that time. Okay, every time the futures position changes, you realize that loss. Okay, So in the example, the company clearly lost money in the derivatives market. Right? Everybody understand this? Okay? So here's the question. Did the CFO make a mistake by shorting futures? By shorting pounds in the future market, being more precise? No, right? Okay, this is not a mistake. The position can move either way. Okay? And what you need to remember is that the goal of the position is not to make money in the futures market, right? The goal of the position is to eliminate the exchange rate risk that you are exposed to, right? And now we have to go back to the beginning, right? The US company not only has a short position in the futures market, but you also have a long position in pounds because you're going to receive 1 million pounds from your counterparty, right? So what happens is that on one hand, sure, you lost money, right, in the futures market. Okay, so this is your financial loss. But you also have a financial gain, right? Because you have a payment of 1 million pounds. If the pound appreciated relative to the dollar, what happens to your payment? Your payment goes up, right? So the magic here is the loss in the futures market is counteracted, is counterbalanced by the gain that you made in your operational position, right? You can think of that as the operation. It's a contract that you're getting from your customer, right? Your customer is paying 1 million pounds, right? And the value of that payment went up. Okay? So the beauty of this is that in this example, the numbers actually exactly match, right? If you think about the match, the math, sorry, right? You had a loss in the futures position, which is $62,700, but you also have a gain, right? Because you're going to receive pounds in the future. You're long pounds, right? So the value of your future payment has gone up. Right? How much has it gone up for? Exactly the same amount. Okay? So if you do an income statement for this company, right? On one hand you lost money on derivatives. On the other hand, you gain money. You made money on your supply contract, right? Your customer contract. This is the UA company is paying, so it's a customer, right? You made money on your customer contract, and the loss exactly balances the gain. Okay? And this is, the number 0 appears again. It's a very important number in finance, and this is something that is worth remembering. Every time you hedge, okay, the goal of hedging is to end up with a 0. Okay? What you want is to eliminate, right? Eliminate a risk means that instead of positive or negative, you end up with a 0. Okay? And it works anyway, right? So we're going to talk about speculation in a second, but let's do here in our mind, just to make sure we understand this, right? So what happens in the other case, right? So suppose that we don't know what's going to happen to the pound dollar, right? So suppose that instead of the pound appreciating relative to the dollar had appreciated relative to the pound. Okay? So this is the risk that the US company was worried about, right? Because the US dollars appreciated relative to the pound, right? Meaning that your payment in pounds now is going to be worth fewer dollars, right? You're getting less dollars for your payment. But if the dollar appreciates relative to the pound, what happens in the futures market? You get a gain, right? Okay? So as long as you have the position in the right direction, the gain always compensates the loss, and the company moves towards 0. This is what hedging is about. just to compare that with speculation, right? So,
Only about the,
okay, go on.
only about exchange risk or in general?
No, in general, any risk. So, for example, we could be, exchange rate, like I said in the beginning, exchange rate is convenient to give examples because we can get the data. It's a little bit tricky because of the numerator and denominator, but it's the one that is easier, I think, for teaching purposes. But this is true for any risk. Interest rate, commodities, right? So, for example, if you're hedging, if you have a steel futures contract, it's the same idea. If you have the position in the right direction, no matter what happens to steel prices, your profits are going to remain the same. Okay? But you could do the wrong thing, right? So, for example, suppose that the CFO now, I started dealing in futures markets, right? I have an MBA from a good school, and I know how to forecast exchange rates, right? So suppose that the CFO believes that the pound is going to continue appreciating. Oh no, this is gonna keep happening, right? So we're gonna close this short position now, right? And now we're going to go long on the pound. Okay, so we're gonna go to the futures market to buy pounds. What's the problem? First of all, right, as we discussed, and this looks like speculation because you're doing it because you think that you're assume that you know how to forecast the exchange rate, so that's the problem, right? The CFO probably cannot. Nobody can forecast exchange rate. That's a problem. But there is another problem, right? So now this company has a long pound position in the futures exchange, right? So let me see if I have it here. No. So let's just talk about this. That'll be another good example. Let's use this, okay? So now you have a long position in futures. So using this framework here, what would be the problem? Let's work it out, right? Suppose that so now you're long, right? So suppose that the pound you're long pound, right? So suppose that the pound depreciates relative to the dollar, right? So you're long pound, so the CFO was wrong. The pound actually depreciated. Okay? So what's going to happen to your futures position? You're long now. You're clever. You went long on the pound depreciated. You lost money, negative, right? And you have your future payment. Your future payment is in pounds. The pound depreciated. What happens? Negative, right? Okay, so now the two risks are going the same direction. Now it's impossible to get zero, right? Either the CFO is going to be a genius, right? If the pound really, let me move here, make sure I don't get the direction. Yeah, if the pound does continue to appreciate, then the CFO is going to be a genius because the value of the payment increases and you make money in the futures market and the profits are going to look great. And the CFO says, look, I'm a genius, right? But you never know. It could go wrong. And then you're going to lose a lot of money. Okay? So the cases we're going to talk about are going to give, real world examples of situations like that. Okay? But everybody understand the difference? Right? So speculation, another way to detect speculation is to think about the direction of the position. If you know what is the company natural exposure, right? In this case, the company is going to has revenues in pounds, we can figure out which direction you should be taking the futures market. And if you are in the wrong direction, even if you're not talking about it, maybe the CFO wants to speculate but doesn't want to disclose to tell the shareholders that is speculation. So say, oh yeah, I'm hedging, right? But if you have the wrong direction, really you are speculating. Or maybe you are trying to hedge, but you don't know what you're doing. You didn't go to a school that was good enough, right? So this is a clear example of speculation for these two reasons. Okay? Any question on this? So as I said in the beginning, there is nothing wrong with trying to speculate on exchange rates, but the CFO should then move to Wall Street. That's not, managing a company's finances is not the right, it's not the right place to be doing this. Okay? Any question? Question on this? Like I said, the more examples we do, the more clear it's going to become, and the cases are going to help as well, and really nail this down. But we're going to have a few more examples today as well, if we have time to finish. Otherwise, we'll finish on that. So, as we just learned, okay, the idea of hedging is to neutralize, is to get zero. So that's an easy thing to remember, right? You want to end up with zero. If you end up with zero in my world, you are a genius. I don't want positive, I want zero. Okay? So net gain of zero. But we're going to see some examples. In some cases, it's going to be difficult to have a perfect zero. Okay, for example, suppose that, we have, I made up the initial examples in a very specific way so we could get perfect hedging. It's good for teaching, but it's unrealistic, right? In the real world, it's, you might have these contracts, right, that are specified in specific amounts, etc. But the real world looks more like this, right? So now we have a U.S. company. Instead of having a contract that specifies exactly £1 million, this company has revenues in the UK, right? So you're selling in the UK, right? So 30% of the revenue comes from UK, right? So the revenues are in pounds, right? And for now, let's assume that the US company produces in the US, right? So your costs are in dollars, okay? And your revenue is in pounds, and we're going to talk about operational hedging in a second, okay? So how can this company hedge currency risk? Right here, we don't have a number, right? But at least we know the direction now, right? So if you're going to hedge this risk in the futures market, right, we can use the same framework. You're receiving payments in pounds, so your operations are long in pounds. What do you need to do in the futures market? Do you have to? Are you long or short pounds? Your operation, your operations are long in pounds, right? Long means you get pounds, right? You're getting pounds from your normal operation. So what do you do in the futures market? Short. Okay? Yeah. That's the most important thing I wanted to get from this is, you can determine the position, right? You can easily determine the direction of the position. Okay? So you have to go short pounds. Right? So if the pound depreciates relative to the dollar, right, you have lower operational profits, right? But you have a gain. You have a gain on your derivatives position. What's the problem now? You don't know what, right? The only difference is now you don't know exactly the size of the position. Right? It's the same economic, it's the same concept. But now the problem is the size of the position depends on your revenues. Right? So suppose that you estimate you can estimate revenues, right? Or you're going to have expected revenues, but you don't know for sure. So suppose that next year revenue is estimated to be $100 million. That's what you expect to sell, meaning that $30 million are going to be in pounds. Right? Okay? So, we know the direction of the position, but what we don't know is, we don't know exactly, right, the revenue. There is uncertainty about the revenue. So now the problem is, the revenue could end up being 120 million, right? and you only hedged 100 because that was your expected value, what's going to happen is there is going to be a residual here that is going to remain unhedged, right? So that's what we call imperfect hedging, right? And which really is the reality. I mean, in the real world, I mean, I can give you some examples that I made up of contracts, but there's always a risk, right? In most cases for companies, there's going to be imperfect hedging because you can't perfectly predict what the foreign currency revenues are going to be. Okay, so there is going to be a residual currency risk here. So there is not only cash flow risk, there is also currency risk. Okay, everybody see that because you're receiving a different amount. It could be good or bad. I mean, in some cases, the residual currency risk may benefit the company, right? But then you also expose it to it. If the exchange rate moves in the wrong direction, right? So in this case, if the pound depreciates relative to the dollar, then you're going to lose money because you only hedged 30 million and you didn't hedge the other 6 million. Okay? Everybody understand that? So, and this is tricky, right? You could be thinking, maybe the way to solve this position is to have okay, so let's increase the size of the position, right? But then the problem is, the position might be too large, right? What if the revenue decreases? The problem is, you're not sure what's going to happen to revenue, right? So now if you increase the position too much and the revenue decreases, then you increase your exposure to currency risk, right? So it does make sense to base your hedge positions on expected values, right? Like many things in finance, the expected value is a good benchmark. But when there is uncertainty, just using the expected value is going to leave the company exposed to residual currency risk, right? So that's why we're gonna talk about alternative methods that real world companies use in order to improve hedging and try to alleviate this imperfect hedging problem. The first one has to do with liquidity. Okay, so let me see if I have time for this. Yeah, we can. I think we can do this example today. Okay, and then we'll wrap up. So, and by the way, that's going to be another example that will help practice these directionals and all that, because that can be a bit mind-boggling. So, suppose now we have, it's December 2014, and we have a US company that needs to make a payment of 200 million rubles to a Russian supplier. So now we're back to the payment situation, right? So you're not receiving revenues in rubles, now you're making a payment in rubles. It's the same example we had before, right? So, what we did, right, in that case is we entered a forward contract, right, that guarantees that the U.S. company was paying $3.082 million in 1 year, right? That's how we solved the problem using forwards. Okay? Turns out though that there is another way to do it, right? You can think about a situation. So in this case, the forward is available. Even if the forward was not available, right? Another way that the company could eliminate the currency risk is to buy rubles today in the spot market. Okay, there is a if there is a current exchange rate, right? And you need to make a payment in rubles. So rather than entering a forward contract and making a payment in dollars in 1 year and getting rubles, what you can do is you can buy the rubles today, right? But that requires the company to do something, right? So if you're buying rubles today, what do you need to do with the rubles? Can you spend it? No, right? You have to hold cash. Yes. Okay? So you have to buy the rubles, but you also have to use your balance sheet. I keep hitting the wrong button. Let me do it like that. Okay? You have to invest, you have to keep the cash in rubles. Right? I mean, you can't spend it. You certainly cannot change it back into dollars. The whole purpose is to eliminate currency risk. Okay, so the US company has to find a way to invest in a safe asset in rubles, which is going to be tricky as well, as we're going to see in a second, but that's the idea, right? So how would this work? We can get data on, suppose, actually this is not the real data, I'll talk about it in a second. Suppose the interest rate in 1-year Russian government bonds is 16.8%. That's high, but it was actually a high rate at the time as well, you're going to see. And then the rate on 1-year US T-bills is 0.2%. We'll use that in a second. Okay? So now we can figure out how many rubles you need to buy today, right? Because you're going to buy rubles, hold cash, so you're going to invest in Russian government bonds, which hopefully is a safe security, right? And so here's the number of rubles that you need to buy, right? Just like standard present value calculation. If you're going to invest it at 16.8%, you need 171.244 million, right? This is in millions. You need a bit more than 171 million rubles. Okay? Then you hold the cash. When the year comes, the end of the year comes, you're going to have 200 and you make a payment to the supplier. Right? You don't have currency risk anymore, if you think about it. Right? This eliminates, this position also eliminates the currency risk. Right? I keep hitting the wrong button. Okay? And we can also calculate, right, how many dollars does it take to buy the rubles today, right? That depends on the current exchange rate. So buying 171 million rubles today will take 3 billion point 7, that number there, right? And this basically means that the company is hedged against exchange rate risk. Okay, everybody understand this? Questions on this? So here's the problem, right? One problem. That's going to be the major problem, right? So it's not going to be the major problem because this one actually is relatively straightforward, right? But if you remember, in our previous example, the company was spending $3,082,000 in 1 year, right? And now we're spending $3,076,000 because we're spending the dollars today. But if you look at the interest rate in dollars, right? This number exactly matches, right? So $3,082,000 today, in present value is equivalent to $3,082,000 in 1 year is equivalent to $3,076,000 today because the interest rate in dollars is 0.2%, and you can do the math to check this. Okay, so it is the same value in dollars. Economically, this is exactly the same transaction. Okay, so really, I triggered this example a bit because I don't know if you took an international finance class already, you probably talked about this concept of interest rate parity. So I assumed that the ruble's interest rate was 16.8%. So essentially I calculated this using an interest parity condition. So you don't have to worry too much about this. But what this means is investors should be indifferent, right, between holding the U.S. bonds and bonds. But here's the problem, right? So if you look at the data, the actual 1 year Russian government bond was not 15. It was 15.6%. So it was close to my calculation, but it wasn't exactly that. Okay. So what this means is now we're going to have a cost of hedging using cash. Right? Because we can't do it perfectly. To have 200 rubles in 1 year, if you redo the math using the actual interest rates that held at the time, okay, the U.S. company would need to buy more rubles, okay, which means that you're going to end up having to spending more dollars than you would with the forward contract. Okay, so there is a cost of hedging with liquidity in this case. okay, because interest rate parity doesn't hold. And really, there is an even bigger problem that I was referring to in the beginning, right? Which is that, you might be wondering, why is the Russian rate so high, right? 15%, that's a very high interest rate. And the problem, of course, is that, we talk about, it's important for the company to try to hold cash in a safe currency. But at that time, Russia was in the middle of a currency crisis. So it was very unclear, whether the investing in a Russian government bond really is, it's probably not a safe investment, right? That we want. But if you want to hedge with liquidity in that example, you really do need to hold your cash in rubles. So there is no way out of there's no way out of this problem. Russian bonds were probably not risk-free, right? So what this means is the U.S. company, if you hedge with liquidity, would have been exposed to credit risk as well, right? By holding Russian bonds. So that's a problem. But in general, what this example shows is that liquidity is an alternative to hedging, right? So you could have hedged, perhaps imperfectly in this case, but you could have hedged your Russian risk by holding cash in rubles instead of entering a derivatives position. And that, of course, can be useful when the derivatives position is not enough, or maybe when derivatives are not sufficient. And then, as we're going to talk about on Monday, there are certain risks that cannot be hedged using derivatives, and then you're going to have to use liquidity to hedge those risks. But liquidity is going to come with additional costs. Okay, so the bottom line is, that's a good time for us to stop, and we'll pick up from here next class. So the bottom line is that if a derivatives is available, as in the Russian example, it will probably be safer and cheaper than liquidity. The real benefit of liquidity is going to be in situations in which a derivative is not available. We're going to talk about the pandemic on Monday. That's going to be an example, and in that case, hedging with liquidity becomes even more useful. Okay, but let's stop here. Next on Monday we'll pick up from the discussion on operational hedging, and then we'll do the two remaining cases that we have. Okay, so thank you and have a nice weekend.
我觉得这部
And I'll
分
see
他
you
早
on
上
Monday
上都
afternoon.
好，我觉得这部分比上午就难好多，他还
因为
上了课。
太快了，因为涉及到一个是 currency 不同之间的 currency 的汇率的转变，所以你在讲的时候就会那个什么。但是这样很容易的一件，比较容易记得的一件事情是。